Joining us for a conversation is world-renowned resource stock analyst Andrew Hecht to discuss oil and gas supply-side inflation. Mr. Hecht, welcome to the show, sir.
Hello, Maurice. It's a pleasure to be back with you.
It's a great time to be speaking with you to discuss oil and gas and the virtues of private energy investments. Let's start off with how oil fits in with your energy mix. Now, we know that the green revolution is upon us with solar, wind, and other renewable energy sources gaining a share in the energy market, and there's no argument for the growth of the EV industry and its relevance going forward as the developed world is embracing the new economy of EVs. How long is oil going to be a relevant player in the energy space?
Well, we have to understand, Maurice, that shifting from traditional energy, meaning oil, gas, coal, is a multi-decade process. You know, if you look out in the street, I think if you go out to a major thoroughfare and you count the number of EVs that go by, I would venture to say that even today, probably 5 out of 100 are EVs and the other 95 are gasoline powered. And trucks are powered by diesel fuel, and they bring goods to market, and certainly planes are powered by jet fuel, which is a distillate. So it's a multi-decade process for the world to switch to alternative and renewable fuels. But the U.S. administration decided that they wanted to accelerate it. And on the first day in office, President Biden canceled the Keystone Pipeline last year in 2021. There were a lot of increases in regulation on fossil fuel production to encourage alternative and renewables. And, U.S. production has declined because of that. And investment in this sector has declined. But to answer your question, how long is oil going to be a relevant player in the energy space? I would say for decades to come.
You gave us 4 reasons for higher oil and gas prices in your recent article. Could you summarize and include your long-term macro story for oil and gas?
Sure. Okay. So the first reason is what I mentioned at the end of my last answer to the last question. The Biden administration's green initiative, it favors alternative and renewable fuels while inhibiting fossil fuel production. U.S. energy policy since 2021 handed the pricing power of the oil market back to OPEC, the International Oil Cartel, and Russia. And after years of suffering under low prices because of U.S. shale and gas production, OPEC Plus now controls and supplies and owes the U.S. and European consumers no favors. Production increases, the requests that the Biden administration made for production increases fell on deaf ears in Riyadh and Moscow and other production capitals. So that's really the first reason for higher prices. Basically, we went from energy independence in fossil fuels to, again, depending on OPEC Plus for the marginal barrel. Now, that was last year. This year created a whole new dynamic. The February 4th no limits handshake between President Xi and President Putin created a bifurcation of the world's nuclear powers, with the US and Europe on one side and Russia and China and their allies on another side. And Russia's invasion of Ukraine, launched the first major war in Europe since World War II. And Russia, sanctions on Russia and Russian retaliation have led to energy distortions, as Russia is a major oil and gas producer feeding natural gas to Europe and supplying oil to many other countries around the world. So the bottom line is that no limits agreement set the stage for the invasion, and the invasion and sanctions on Russia and Russian retaliation against who they call unfriendly countries set the stage for much higher prices. But oil and gas prices were already rising before, these problems, these geopolitical problems in 2022. So, and that's the third reason. Oil and gas prices have been rising despite the COVID-19 lockdown in China, which we're now coming out of. And as the Chinese economy reopens, it puts more upside pressure because of the number of people, in China who consume fossil fuels. China is not 100% on board with the green path to energy, nor is India, which has not cooperated with the US and Europe with sanctions on Russia. And we have to remember, Maurice, that China and India account for more than 1/3 of the world's population. And they are both growing economies using lots of energy. So even if the US was to shift back to a drill baby drill or frack baby frack approach to traditional energy, it would have problems right now. There are labor shortages and higher input costs because of inflation. And moreover, the Biden administration has doubled down on its green initiatives, saying that, no pain, no gain, that, consumers have to take the current pain so that this transition can happen. Now, personally, not to get too political, but I think that's pretty short-sighted view, and that, changing energy policy is really a multi-decade rather than a multi-month process.
I think many would agree with you. What are the short and long-term effects on the oil supply from the geopolitical events gripping Europe?
Well, look, Russia is a big producer of oil. There are three big producers of oil in the world. Saudi Arabia is number one, Russia and the United States. In March 2020, the U.S. produced 13.1 million barrels of crude oil per day. Today, we're producing about 10.9 million barrels per day, 11.9 rather, million barrels per day, according to the EIA. So the bottom line is less U.S. production makes the world, the U.S. and the rest of the world, more reliant on Moscow and Riyadh for oil. And Moscow is a big player in the gas industry, supplying all of Europe. So war in Ukraine is weighing on Russian oil production. And, the U.S. is now letting out the oil from our strategic petroleum reserve to keep prices down. But hey, I've been trading oil since the early 1980s, and I'll tell you this much: every SPR release has not put a cap on oil prices, and every barrel that we sell, we're going to have to replace. So today's selling out of SPR just means we're going to have to replace it in the days and years to come. So the short-term effects of war are certainly bullish for the oil price because of what I mentioned. The U.S. Relations with the Saudis and the Russians naturally are not good. So higher oil prices are to their benefit. I mean, Russia is funding their war with energy. And the Saudis, after suffering, it takes about $80 a barrel to balance the Saudi oil budget. And at $120, it's an earnings bonanza that they're not going to shut off anytime soon. It doesn't behoove them to do that.
No, it doesn't make financial sense for them, nor does it make financial sense for us.
Not at all.
So, sticking with oil prices, given that the oil prices are forecasted to continue their climb, what is the overall impact of the oil prices with the effects of inflation? And are there any supply side changes that will cool oil prices in your view?
Okay. It's a compound question.
Mm-hmm.
So first, oil prices. Inflation is a difficult beast to tame. Okay. So in my opinion, and this is one man's opinion, oil prices are critical inputs in inflation right now. And the Fed is trying to use demand side tools. Interest rate policy, monetary policy is a demand side tool. Okay, you raise interest rates, you stifle economic growth to slow the economy, to put a cap on inflation. The problem is that rising oil is a supply side issue caused by U.S. energy policy compounded by the war. I don't see the only supply side change that I can see that will cool oil prices is if the U.S. goes back to a drill baby drill and frack baby frack policy. And I do not see that happening in the foreseeable future unless the government changes. So that's my answer there. I don't see a supply side change because I think they have bought in on the green revolution. As far as the oil's impact on inflation, inflation is a vicious cycle. And oil is feeding it, it's fueling it. And since I don't see the demand side tools pushing oil prices appreciably lower, I think that oil will continue to fuel inflation, and it's going to be very difficult to contain.
Now, the lay investor may want to, I guess if you can say, take advantage of these opportunities in the oil market, and they're going to look at general equities usually. But you have a treat, if I may say, for those that are listening here. How can an investor take advantage of this current oil pricing environment that appears to be with us for some time? There's some obvious public companies to invest in, but there seems to be an opportunity in the private sector. And I want to emphasize this on the private sector for investment, as well as given the inevitable increase needed in the domestic supply. What are some of the advantages of investing in a publicly listed company versus as some of those that you listed in your article? And then we'll highlight those that are the advantages and merits of the private oil and gas companies, beginning with the public.
So I highlighted the XOP, which is the kind of drilling and exploration ETF. The other one is the XLE, which is the highly liquid, ETF product that holds U.S. oil companies. And, the increase in regulation has created a virtual monopoly for some of these companies because it takes a lot of capital to be in the oil business. And, with an unfriendly regulatory environment, those who are existing, who are well capitalized, can take advantage of these higher prices. But new entrants, it is very difficult for new entrants. And also, with the labor problems, getting people to work for new companies coming on stream is very difficult. A lot of people who were working in the shale regions, in the Marcellus and Utica shale and in the other shale regions of the U.S., lost their jobs in 2020 when crude oil went into negative territory and natural gas fell to a 25-year low, and are now working for Amazon and other companies. And it's very hard to bring them back to work. So, there is a monopoly for the Chevrons, the Exxons, and they're kind of main holdings of these big ETFs that have done incredibly well. The XLE, for example, it ended 2021 at $55.50 a share. Today, it's over $91 a share. And that's in a stock market that's down on the year, Maurice. So, these have done very, very well. And the only thing I will say about this is that the higher prices rise, and that's oil prices, gas prices, coal prices, equity prices, the higher the chances of vicious corrections. However, the trends are higher, and I think that dips are a buy in this sector.
Now, what are some advantages of investing in a private oil and gas company?
Well, there are tax advantages, and there are certainly advantages if you do your homework to locate good companies with good management that can really take advantage of this current pricing situation. The tax advantages to help de-risk an oil and gas investment, depending on investors' individual tax position. And we always have to check with our accountants and tax attorneys in terms of any investment that we do in a private company. Investors who have a tax balance owing during the fiscal year of their oil and gas investment have historically been able to write off over 70% of their investment against taxes that they owe. In other words, a chunk of your dollars previously earmarked for tax payments can instead see those dollars now invested in an oil and gas investment with potential to create cash flow income going forward. Now, that is under the current tax regime. But I will say, there is a chance under this administration that that could change because of the Green New Deal that we're under. We are, the government is inhibiting fossil fuel production in the interest of the environment. So we have to be careful with those, and we have to really pay attention to the ongoing changes in the tax code for these oil and gas investments. However, they can be very interesting, and certainly at these prices, they're making money hand over fist. And why not have some risk capital invested in this, in this private area?
One of the virtues is the initial write-off of 70%, as you alluded to, and that's plus or minus there. But there's also tax savings on the potential income generated on the private energy investment. Is that correct?
Yes, an investor, as an investor who invested directly in a well-born oil and gas asset, can benefit by writing off the expenses of the drilling and operating costs against the investment income. And those costs, because of inflation, are rising. So those investment costs, those drilling and those fracking costs are going higher. So that is a write-off, certainly, on those private investments. But again, I urge everyone who's considering these investments to check with their accountant, to check with their tax attorney, and to keep up. You have to do your homework on these investment opportunities and these partnerships. But you also have to now keep abreast of the changes in the tax code and the changes in the U.S. energy policy, which are going to affect these investments. Now, that can change after the midterm elections, and we could be very much status quo. But, there are a lot of voices in Washington, D.C. that want to change everything and kind of get the tax code more green, if you know what I mean.
Well, ladies and gentlemen, if the value proposition of a private oil well is of interest to you, if you've been following our work, we have been conveying that we are participating in an oil well. If you'd like to get more information on that, please give me a call at 855-505-1900. That's 855-505-1900. Or you may email contact@provenandprobable.com. That's contact@provenandprobable.com. Mr. Hecht, thank you for your valuable insights today. Before we close, what did I forget to ask?
Well, I was prepared for this because this is my not my first rodeo with you, Maurice. And I will say the following. One of the things I really would like to point out is where the seeds from inflation came from. Where did this all start? Why were oil prices rising before Russia went into Kuwait? And why were natural gas prices rising? And we talked about U.S. energy policy, which is certainly a very important reason. But the inflationary seeds came from historically low interest rates that started in March 2020. Those were modified, genetically modified by government stimulus packages that went, to a ubiquitous audience. Look, I'll speak freely about this topic. My parents, who are in their 90s, my mother-in-law who lives with us, who's almost 90.
Amen.
They received, amen, God bless them. But they received stimulus checks, as did my children. They didn't need them, okay? They did not need those stimulus checks. So the kind of spraying of stimulus throughout the economy without really, I had no problem with giving stimulus to people who needed it to pay rent, to pay food, who lost their jobs. But it went far beyond that. And it's created terrible inflation. And these poor people who received those checks will now, for the coming years, face much higher prices in food, in energy, in all goods and services. And these inflationary seeds, they sprouted in the second half of 2020. They bloomed in 2021. And in 2022, they were turbocharged by a war created by Russia, a terrible humanitarian issue going on in Ukraine, but also a problem for the world in terms of both energy and food supplies. And the inflation that started is being turbocharged by this war. So, and again, as I mentioned earlier in the interview, the Fed has demand side tools. Monetary policy is a demand side tool. You can raise interest rates and that will stifle demand. But when you have supply side issues and you can't access cheap energy, you can't access food and feed people, this is a very, very dangerous type of situation, which will fuel inflation. So the little seeds that the Fed planted and the government watered in 2020 gave way to the inflation last year, and the war has only made it worse. And oil is on the front lines. Oil, along with food, along with wheat and soybeans and corn and other, food products that feed the world. And unfortunately, it's a vicious cycle that I expect to continue here because the Fed alone can't end this. What can end it? If the U.S. drills more oil, realizes that we need to, in order of world security, we need to drill more, and we have to find a way to make peace in Europe, because that is the critical thing right now that's really fueling this inflation.
I say this in the most complimentary way, but I hate to agree with your analysis. Well, Mr. Hecht, for someone that wants to learn more about your work, besides finding it on provenandprobable.com, where can they find you?
They can find me on Seeking Alpha. I write there once or twice a week. They can find me on Bar Charts. I write there every weekday. They can find me investing.com and through Bubba Trading, where I do a podcast on Mondays. And, I'm out there writing about all these commodities.
Hey, you do great work, sir. All right. Mr. Hecht, it's been a pleasure speaking with you today. Wishing you the absolute best, sir.
Thank you, Maurice. Look forward to next time.
All the best, sir.
The information presented on Proven and Probable is provided for educational and informational purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, or fitness for any particular purpose. The information is not intended to be and does not constitute financial, investment, or trading advice, or any other advice. You should not make any financial, investment, or trading decision based on any of the information presented without first undertaking independent due diligence and consultation with a professional broker or competent financial advisor.